Question 1. Which of the following best describes the primary benefit of forming a captive insurance company? A. Captive insurance companies are exempt from state and federal tax requirements. B. Captive insurance allows businesses to retain and manage their own risks, offering greater control over insurance costs and coverage. C. Captive insurance companies offer lower premiums than traditional insurers for all types of coverage. D. Captive insurance companies are only available for large multinational corporations. Answer: B. Captive insurance allows businesses to retain and manage their own risks, offering greater control over insurance costs and coverage. Explanation: the primary benefit of forming a captive insurance company is the ability for businesses to take control over their own risks and insurance costs. Captives allow businesses to manage their unique risk profiles, set retention levels, and have more flexibility in structuring their insurance policies. While captives can lead to cost savings, they are not exempt from tax requirements. The statement about low premiums is not necessarily true for all types of coverage, as the cost savings depend on the specific risks and claims experience of the company. Additionally, captives are not limited to large multinational corporations, as smaller businesses can also form captives depending on their risk management needs. Question 2. Mr. Thompson owns a medium-sized manufacturing company and is considering forming a captive insurance company. His business is experiencing rising insurance premiums, and he believes a captive could provide more tailored coverage for his specific risks. What is the first step Mr. Thompson should take in forming a captive? A. Hire a reinsurance broker to structure the reinsurance arrangements for the captive. B. Conduct a feasibility study, including a risk analysis and financial projections. C. Immediately submit an application to the Wisconsin Department of Insurance for a captive license. D. Select a captive management company to handle the operational tasks of the captive. Answer: B. Conduct a feasibility study, including a risk analysis and financial projections. Explanation: the first step in forming a captive insurance company is conducting a comprehensive feasibility study. This includes a risk analysis, financial projections, and a cost-benefit analysis to determine whether the captive would be a viable option for the business. The feasibility study assesses the potential risks, the required capital, and the long-term benefits of forming a captive. After this, steps such as selecting a captive management company or securing reinsurance can be pursued. The application for a captive license should not be submitted before this critical analysis is completed. Question 3. Scenario-based. MS Sanders is the owner of a small tech startup. The company has faced multiple cyber attacks over the past few years, leading her to consider forming a captive insurance company to better manage cyber risk. She is aware of the potential benefits of captives but is uncertain about how to address the issue of reinsurance. Which of the following should MS Sanders consider when designing her captive's reinsurance strategy for cyber risk? A. Her captive should not include reinsurance in its strategy as cyber risk is too volatile to transfer. B. The captive should secure a facultative reinsurance arrangement to transfer specific large risks associated with cyber incidents. C. The reinsurance strategy should focus solely on transferring all cyber risks to an external reinsurer, leaving the captive with no retained risk. D. The captive should avoid any reinsurance arrangements to minimize administrative costs and retain all of the risk. Answer: B. The captive should secure a facultative reinsurance arrangement to transfer specific large risks associated with cyber incidents. Explanation: in a captive insurance company, reinsurance can be an effective way to manage the financial impact of large or catastrophic risks. For cyber risks, which are unpredictable and potentially severe, facultative reinsurance allows the captive to purchase coverage on a case-by-case basis for specific large exposures. This provides flexibility and helps manage the volatility of such risks without transferring the entire risk portfolio to an external reinsurer. Option A is incorrect because captives can use reinsurance to manage risks effectively, and option C is incorrect as it would not allow the business to retain any of the risk. Option D is also incorrect because while cost saving is important, completely avoiding reinsurance could lead to significant financial strain if a large cyber incident occurs. Question 4. Which of the following is a key regulatory requirement for captive insurance companies operating in Wisconsin? A. Captive insurance companies are required to maintain a minimum capital and surplus in accordance with Wisconsin's statutory requirements. B. Captives must always file their annual financial reports with the IRS before submitting them to the Wisconsin Department of Insurance. C. Captives in Wisconsin are exempt from audits if they are smaller than $10 million in assets. D. Captives must pay all claims in full within 30 days of notification to remain compliant with Wisconsin regulations. Answer A. Captive insurance companies are required to maintain a minimum capital and surplus in accordance with Wisconsin's statutory requirements. Explanation: in Wisconsin, captive insurance companies must adhere to the state's statutory requirements, which include maintaining a minimum amount of capital and surplus. This is essential to ensure that captives remain financially solvent and can meet their obligations to policyholders. Captives are also required to submit their financial reports to the Wisconsin Department of Insurance (OSI) annually. The IRS does not directly govern captive reporting in this context, so option B is incorrect. Captives are subject to audits regardless of their size, making option C incorrect. Regarding claims payments, there is no specific 30-day requirement to remain compliant with Wisconsin law as suggested in option D. Question 5. When evaluating the feasibility of forming a captive insurance company, which of the following should be a primary focus in the feasibility study? A. Determining the total cost of insurance premiums in the first year of operation. B. Estimating the future profitability of the captive based on expected claims and risk retention. C. Assessing the regulatory changes in other states unrelated to the captive's domicile. D. Forecasting the captive's ability to offer life insurance products within the first 5 years. Answer: B. Estimating the future profitability of the captive based on expected claims and risk retention. Explanation: a key part of the feasibility study involves estimating the future profitability of the captive, taking into account factors such as expected claims, risk retention, and potential savings from forming the captive. This analysis ensures that the captive is financially viable over the long term and helps owners assess whether it is a prudent risk management strategy. While premiums in the first year, option A, are important, they should not be the sole focus of the feasibility study. Regulatory changes in other states, option C, are typically less important unless they directly affect the captive's operation within Wisconsin. Forecasting life insurance products, option D, is not typically a primary focus unless the captive is specifically set up to provide such coverage. Question 6. Mr. Patel operates a large retail business with global operations. He's interested in using a captive insurance company to manage both property and liability risks. He is unsure whether reinsurance is needed for his captive. Which of the following is the best strategy for Mr. Patel's captive regarding reinsurance? A. The captive should transfer all property and liability risks to a reinsurer to minimize its exposure. B. The captive should retain a portion of the property and liability risks while using reinsurance to cover larger, more volatile risks. C. The captive should not purchase reinsurance for any type of risk as it increases overall insurance costs. D. The captive should only use reinsurance for liability risks as property risks are too predictable to warrant reinsurance. Answer: B. The captive should retain a portion of the property and liability risks while using reinsurance to cover larger, more volatile risks. Explanation: in a captive insurance setup, it is common to retain some portion of the risks, both property and liability, while purchasing reinsurance to cover larger or more catastrophic risks. This strategy allows the captive to control its costs and retain the benefits of underwriting profits while protecting against large losses that could threaten its solvency. Option A is not ideal because transferring all risks to a reinsurer would limit the captive's profitability and control. Option C is incorrect because while reinsurance increases costs, it also provides a safeguard against large, unpredictable claims. Option D is incorrect because property risks can also be volatile, particularly in certain industries. Question 7. In Wisconsin, which of the following is a requirement for captive insurance companies to maintain solvency? A. Captives must establish and maintain appropriate loss reserves and provide detailed financial projections for the next 5 years. B. Captives are allowed to operate without any minimum capital requirements as long as they have adequate risk retention. C. Captives must file quarterly reports to the Wisconsin Department of Insurance regardless of their size or risk level. D. Captives must pay all outstanding claims within 60 days to maintain solvency. Answer: A. Captives must establish and maintain appropriate loss reserves and provide detailed financial projections for the next 5 years. Explanation: Wisconsin requires captives to maintain solvency by establishing appropriate loss reserves and providing financial projections for the future. This ensures that the captive has the financial capacity to cover potential future claims and remain solvent. Loss reserves are crucial for meeting obligations to policyholders and maintaining the integrity of the captive. Option B is incorrect because captives must meet minimum capital and surplus requirements to operate. Quarterly reports are typically required for larger captives, but not always for all captives. Option C. Paying claims within 60 days. Option D is not a solvency requirement in Wisconsin, though timely claims payments are important for regulatory and operational reasons. Question 8. Which of the following best describes the purpose of a feasibility study when forming a captive insurance company? A. To determine if a captive insurance company is more profitable than purchasing traditional insurance. B. To assess the risks the captive will insure and determine the appropriate capital and financial structure. C. To analyze the legal structure of the captive without considering financial implications. D. To evaluate potential investment opportunities for the captive's assets, regardless of risk exposure. Answer. B. To assess the risks the captive will insure and determine the appropriate capital and financial structure. Explanation. The primary purpose of a feasibility study for a captive insurance company is to assess the risks that the captive will cover and determine how much capital will be required to support those risks. The study includes a detailed financial analysis to ensure that the captive will be viable, sustainable, and financially sound. Option A is too narrow because a feasibility study goes beyond just profitability. Option C overlooks the importance of financial and risk assessments. Option D incorrectly focuses on investment opportunities, which are only a part of the overall strategy, not the primary focus of the feasibility study. Question 9. Scenario-based. Mr. Lewis owns a small company that operates in a high-risk industry, and he is considering using a group captive to manage his insurance needs. However, he is concerned about the risks associated with participating in a group captive and how they might affect his company's finances. What should Mr. Lewis carefully review before committing to joining the group captive? A. The financial stability and solvency of the group captive, as well as the governance structure and risk-sharing arrangements. B. Whether the group captive has a diversified portfolio of insurance policies, even if unrelated to his business. C. The personal reputation of the other group captive members, as their industry experience is most important. D. The expected return on investment from the captive's reinsurance arrangements, as it will directly benefit Mr. Lewis's company. Answer. A. The financial stability and solvency of the group captive, as well as the governance structure and risk-sharing arrangements. Explanation. Before joining a group captive, Mr. Lewis should carefully assess the financial stability and solvency of the group, as well as how risks are shared among the members. It is crucial that the group captive can handle potential claims and that governance and risk-sharing arrangements are clearly defined and fair. Option B is less relevant since the focus should be on the risks relevant to Mr. Lewis's business, not the portfolio of unrelated policies. Option C is not the priority, as the financial health of the group is more critical than personal reputations. Option D is incorrect because while reinsurance is part of the strategy, the immediate concern is the overall financial health and governance structure of the group captive. Question 10. Which of the following is a benefit of utilizing reinsurance in a captive insurance program? A. Reinsurance allows captives to completely eliminate the need for loss reserves. B. Reinsurance provides captives with a means to spread risk and protect against catastrophic losses. C. Reinsurance always leads to lower overall insurance costs for the captive. D. Reinsurance is required by law for all captives operating in Wisconsin. Answer. B. Reinsurance provides captives with a means to spread risk and protect against catastrophic losses. Explanation. Reinsurance is a common practice in captive insurance, primarily used to spread risk and protect the captive from large catastrophic losses that could exceed its financial capacity. It helps maintain solvency and stability. Option A is incorrect because while reinsurance can help manage large risks, captives still need to maintain appropriate loss reserves. Option C is not always true, as reinsurance can sometimes increase costs depending on the structure and the types of coverage. Option D is incorrect because reinsurance is not mandatory for captives in Wisconsin, although it is often used for risk management purposes. Question 11. Which of the following is a primary regulatory requirement for captives in Wisconsin regarding their operations? A. Captives must be domiciled in Wisconsin to operate legally within the state. B. Captives must submit an annual audit report conducted by an independent auditor to the Wisconsin Department of Insurance. C. Captives must purchase insurance from third-party insurers for all risks, including property and liability. D. Captives must not have any reinsurance agreements in place under Wisconsin law. Answer. B. B. Captives must submit an annual audit report conducted by an independent auditor to the Wisconsin Department of Insurance. Explanation: Wisconsin requires captives to submit an annual audit report conducted by an independent auditor to ensure that the captive is financially sound and meeting its regulatory obligations. Captives can be domiciled in Wisconsin, but are not required to be in order to operate there. Additionally, captives can enter into reinsurance agreements and do not need to purchase insurance from third parties for all risks. Question 12. When establishing a captive insurance company in Wisconsin, which of the following factors should be included in the business plan submitted to the Wisconsin Department of Insurance? A. A detailed description of the captive's investment strategy. B. A breakdown of the individual member's personal assets. C. An outline of the company's marketing strategy for selling insurance products. D. A specific proposal for integrating the captive into the corporate structure, detailing risk management strategies. Answer: D. A specific proposal for integrating the captive into the corporate structure, detailing risk management strategies. Explanation: When establishing a captive insurance company, a business plan should detail the company's risk management strategies, how the captive will be integrated into the corporate structure, and its plans for addressing potential risks. A detailed investment strategy, option A, is also important, but it should be related to the captive's operations. Personal assets of members, option B, and marketing strategies for selling products, option C, are not typically part of the business plan for captives in Wisconsin. Question 13. Which of the following is true regarding the formation of a Wisconsin-domiciled captive insurance company? A. The captive must have a minimum of 5 members to be eligible for formation. B. The company must demonstrate financial viability, including a plan for adequate risk retention. C. A Wisconsin-domiciled captive must exclusively insure risks within Wisconsin. D. The Wisconsin Department of Insurance must approve all claim payments made by the captive. Answer: B. The company must demonstrate financial viability, including a plan for adequate risk retention. Explanation: When forming a Wisconsin-domiciled captive, the company must demonstrate that it is financially viable and has a plan for managing and retaining the appropriate risks. Captives in Wisconsin can insure risks outside the state. Option C is incorrect, and the Wisconsin Department of Insurance does not need to approve claim payments. Option D. Additionally, there is no requirement for a minimum number of members. Option A. Question 14. In Wisconsin, which of the following types of insurance can a captive typically write? A. Only property insurance for the parent company. B. Only liability insurance for third parties. C. A broad range of coverage, including property liability, workers' compensation, and other types of business risks. D. Only personal insurance for individuals related to the parent company. Answer: C. A broad range of coverage, including property liability, workers' compensation, and other types of business risks. Explanation: Captives in Wisconsin can write a wide variety of insurance policies, including property liability, workers' compensation, and other types of business-related coverage. Captives are often used by companies to self-insure their risks and to control costs, making them flexible in the types of coverage they can offer. Question 15. Which of the following is not a benefit of using a captive insurance company for risk management? A. Ability to retain underwriting profits. B. Greater flexibility in policy terms and coverage. C. Guaranteed low premiums compared to traditional insurance. D. Control over claims handling and risk management. Answer: C. Guaranteed lower premiums compared to traditional insurance. Explanation: One of the benefits of using a captive insurance company is the ability to retain underwriting profits. Option A. Have greater flexibility in policy terms. Option B. And maintain control over claims handling. Option D. However, a captive does not guarantee lower premiums compared to traditional insurance, especially in the early stages of formation, as it depends on the captive's risk profile and financial structure. Thus, option C is incorrect. Question 16. Mr. Taylor is considering using a captive insurance company to insure his company's property and casualty risks. He is concerned about the capital requirements for setting up the captive in Wisconsin. Which of the following is true regarding capital requirements for captives in Wisconsin? A. Wisconsin has no minimum capital requirement for captives. B. Captives in Wisconsin must have at least $1 million in capital. C. Captives must have a minimum capital of $5 million for property insurance coverage. D. The capital requirements are determined on a case-by-case basis based on the risks being insured. Answer: D. The capital requirements are determined on a case-by-case basis based on the risks being insured. Explanation: in Wisconsin, the capital requirements for captives are determined on a case-by-case basis depending on the type and volume of risks being insured. The state does not have a fixed minimum capital requirement for all captives, though the amount of capital required will vary based on the risks involved and the size of the captive's operations. Question 17. Which of the following factors does the Wisconsin Department of Insurance consider when reviewing the financial stability of a captive insurance company? A. The number of employees in the captive insurance company. B. The captive's ability to meet regulatory reporting requirements. C. The captive's parent company's credit rating. D. The personal financial status of the captive's board members. Answer: B. The captive's ability to meet regulatory reporting requirements. Explanation: the Wisconsin Department of Insurance evaluates a captive's financial stability by reviewing its ability to meet regulatory reporting requirements, which include submitting annual financial statements and audits, maintaining adequate reserves, and ensuring proper governance. While the credit rating of the parent company and the financial status of the board members may be relevant for some aspects, the primary concern for the department is whether the captive is compliant with state regulations. Question 18. Scenario-based. ABC Manufacturing is considering setting up a captive insurance company to handle its workers' compensation claims. The company expects that the number of claims will vary greatly from year to year. What is the best way for ABC Manufacturing to manage this volatility? A. Purchase additional workers' compensation insurance from a traditional insurer to cover any large claims. B. Set up a reinsurance agreement with another insurer to protect the captive from catastrophic claims. C. Retain all the risks associated with workers' compensation claims and avoid any reinsurance or third-party insurance. D. Reduce the deductible on workers' compensation claims to the minimum amount allowed by Wisconsin law. Answer: B. Set up a reinsurance agreement with another insurer to protect the captive from catastrophic claims. Explanation: since ABC Manufacturing expects high volatility in workers' compensation claims, setting up a reinsurance agreement with another insurer will help protect the captive from catastrophic claims that exceed its financial capacity. This allows the captive to retain manageable risks while protecting itself from large unexpected losses. Option A is not ideal because ABC is seeking to use a captive to retain risk, not to purchase additional traditional insurance. Option C is risky because it could leave the company vulnerable to large claims. Option D is irrelevant because adjusting the deductible will not address the volatility in claims. Question 19. In Wisconsin, what is one of the primary purposes of forming a group captive insurance company? A. To reduce regulatory oversight by the Wisconsin Department of Insurance. B. To pool risks among multiple unrelated companies and share the costs of insurance. C. To limit liability exposure to only the parent company. D. To allow each member company to manage its own claims independently. Answer: B. To pool risks among multiple unrelated companies and share the costs of insurance. Explanation: group captives are formed when multiple companies come together to pool their risks, share the costs of insurance, and provide coverage for risks that would otherwise be difficult or expensive to insure individually. This structure helps reduce costs and improves risk management. The group still faces regulatory oversight, and the members share claims handling responsibilities, not manage them entirely independently. Question 20. Which of the following is required for a Wisconsin-domiciled captive insurance company to maintain its license to operate? A. The company must provide a quarterly update of its financial performance to the Wisconsin Department of Insurance. B. The captive must conduct an independent audit annually and submit the results to the department. C. The captive must pay all claims within 30 days of receipt to remain compliant. D. The company must issue a report to the Wisconsin Department of Insurance detailing all investment decisions made during the year. Answer: B. The captive must conduct an independent audit annually and submit the results to the department. Explanation: to maintain its license, a Wisconsin-domiciled captive insurance company is required to undergo an independent audit annually and submit the results to the Wisconsin Department of Insurance. This ensures the financial integrity of the captive and its ability to meet obligations to policyholders. What quarterly updates are not typically required? Option A. Paying claims within 30 days of receipt. Option C is not a general requirement for maintaining a captive license, and the reporting of investment decisions. Option D is not a typical regulatory requirement. The primary focus is on ensuring the captive's financial health and compliance through the annual audit, which is why option B is the correct answer. Question 21. Which of the following would most likely be a reason for a Wisconsin-domiciled captive insurance company to fail its solvency test? A. The captive has accumulated excessive reserves that are not justified by the risk profile of its policies. B. The captive's management fees are higher than typical industry standards. C. The captive's total assets are lower than its liabilities, resulting in a negative net worth. D. The captive invests in a diversified portfolio, reducing exposure to market risk. Answer: C. The captive's total assets are lower than its liabilities, resulting in a negative net worth. Explanation: Solvency is assessed by comparing a captive's assets and liabilities. If liabilities exceed assets, resulting in a negative net worth, the captive is considered insolvent and fails the solvency test, while excessive reserves, option A, or high management fees, option B, can be concerns that do not directly lead to a solvency issue unless they directly affect the company's financial stability. A diversified portfolio, option D, is typically seen as a positive risk management strategy. Question 22. What is a key advantage of utilizing a group captive insurance arrangement over a single parent captive? A. Group captives typically offer better access to capital and investment opportunities. B. Group captives allow for sharing of underwriting and operational costs among multiple members. C. A group captive has fewer regulatory requirements than a single parent captive. D. Group captives are less susceptible to market volatility than single parent captives. Answer: B. Group captives allow for sharing of underwriting and operational costs among multiple members. Explanation: A group captive involves multiple members pooling their resources to share risks and reduce costs. This structure enables members to share underwriting costs, operational expenses, and sometimes even claims, making it more cost-effective for smaller businesses or organizations. While group captives may have some advantages in terms of cost sharing, they often have more complex regulatory and management requirements than single-parent captives. Market volatility affects both types similarly, so option D is not accurate. Question 23. Scenario question. Mr. Wilson, the CFO of a medium-sized manufacturing company, is considering forming a captive insurance company to manage his company's property and liability risks. After conducting a feasibility study, it is found that the company's risk profile is relatively stable and their projected claims will not significantly increase in the next 5 years. Which of the following should Mr. Wilson prioritize in the next step of the process? A. Identifying an offshore domicile with the lowest regulatory requirements. B. Establishing a robust claims management system even though claims are expected to be low. C. Filing an application for a captive license without further analysis. D. Reviewing the company's investment strategy and creating a business plan for the captive. Answer: D. Reviewing the company's investment strategy and creating a business plan for the captive. Explanation: In the formation of a captive insurance company, it is crucial to develop a comprehensive business plan that includes the company's risk management strategy, underwriting policies, investment strategy, and other operational details. What claims management, option B, is important. Mr. Wilson should first focus on ensuring the financial sustainability of the captive through an effective investment strategy and a well-structured business plan. Identifying an offshore domicile, option A, may not be the best choice if Wisconsin is the preferred domicile, and filing without further analysis, option C, could be premature. Question 24. Which of the following is the primary purpose of a feasibility study when forming a captive insurance company? A. To identify the specific insurance coverages the captive will provide. B. To assess the financial viability and risk tolerance of the captive. C. To choose the domicile for the captive and ensure regulatory compliance. D. To negotiate reinsurance contracts and premium pricing. Answer: B. To assess the financial viability and risk tolerance of the captive. Explanation: A feasibility study is conducted to evaluate the financial viability of forming a captive, including a detailed assessment of the risk profile, expected claims, projected costs, and the company's ability to meet regulatory requirements. The study also helps to define risk tolerance levels, which will guide the captive's operations. While choosing a domicile, option C, and identifying coverages, option A, are part of the process, they are secondary to assessing financial viability. Reinsurance contracts, option D, are typically negotiated after the feasibility study. Question 25. Which of the following financial reporting requirements is most commonly mandated for a Wisconsin-domiciled captive insurance company? A. Monthly filings of financial statements with the Wisconsin Department of Insurance. B. Annual filing of audited financial statements, including a balance sheet and income statement. C. Quarterly submission of claims data to the department. D. Submission of an independent actuarial report every 3 years. Answer B. Annual filing of audited financial statements, including a balance sheet and income statement. Explanation: Wisconsin domiciled captive insurance companies are required to submit annual financial reports that are audited by an independent auditor. These reports must include a balance sheet, income statement, and other financial disclosures to demonstrate the captive's financial health. Monthly filings, option A, and quarterly claims data submissions, option C, are not standard requirements. The actuarial report, option D, is required, but not on a 3-year basis. It should be submitted annually, typically in conjunction with the financial statement filing. Question 26. What is one of the primary risks associated with a captive insurance company's decision to retain a high level of risk rather than transferring it through reinsurance? A. The company may face higher regulatory scrutiny for having insufficient capital. B. The company could experience significant capital erosion if claims exceed projections. C. The company would face lower operational costs due to avoiding reinsurance premiums. D. The company would be unable to diversify its risk portfolio effectively. Answer B. The company could experience significant capital erosion if claims exceed projections. Explanation: Retaining a higher level of risk means the captive is assuming more of the financial burden in the event of claims, which can lead to significant capital erosion if claims are higher than anticipated. This is a fundamental risk management concern for captives. While avoiding reinsurance premiums, option C, might reduce operational costs, it also increases the risk of financial instability, especially in the event of large claims. Insufficient capital, option A, is a concern, but it is typically addressed by setting aside appropriate reserves and ensuring regulatory compliance. Diversifying risk, option D, is not directly affected by reinsurance, but rather by the captive's risk management practices. Question 27. Which of the following describes a rent-a-captive arrangement? A single-parent captive that allows other companies to use its insurance coverage on a short-term basis. B. A captive insurer that rents its insurance license and infrastructure to multiple non-affiliated entities. C. A group captive where businesses from various industries pool their risks together. D. A captive that provides temporary coverage for policies that are typically non-traditional. Answer B. A captive insurer that rents its insurance license and infrastructure to multiple non-affiliated entities. Explanation: A rent-a-captive is a business arrangement where an entity rents its captive insurance company's license, infrastructure, and other resources to non-affiliated businesses that want to access captive insurance benefits without forming their own captive. This allows smaller companies to benefit from captive insurance without the full investment required to establish their own. The other options do not accurately describe a rent-a-captive. Question 28. How does the Wisconsin Department of Insurance, OSI, ensure the financial stability of captives operating in the state? A. By conducting monthly financial audits of each captive insurer. B. By imposing strict solvency margin requirements and reviewing financial reports annually. C. By approving the reinsurance contracts for all captives domiciled in Wisconsin. D. By offering financial guarantees for captive insurers to ensure solvency. Answer B. By imposing strict solvency margin requirements and reviewing financial reports annually. Explanation: The OCI requires captives to maintain solvency margins, capital buffers that ensure a captive can meet its obligations even in the face of unexpected claims. Additionally, annual financial reports, including audited financial statements, are reviewed to ensure the captive's financial health. Monthly audits, option A, are not typical for captives, and while reinsurance contracts are part of the regulatory process, the OCI does not approve them, option C. The department does not provide financial guarantees, option D. Question 29. What is one of the primary benefits of utilizing reinsurance in a captive insurance structure? A. Reinsurance enables captives to offer more customized policies to their policyholders. B. Reinsurance helps captives share risk, improving their financial stability and solvency. C. Reinsurance is typically used to reduce the regulatory capital requirements for captives. D. Reinsurance increases a captive's ability to directly manage claims in-house. Answer B. Reinsurance helps captives share risk, improving their financial stability and solvency. Explanation: reinsurance allows captives to transfer some of their risks to other insurance companies, which helps them manage large losses and ensures financial stability. By sharing risk, captives can better protect themselves from claims that exceed their capital, while reinsurance does not directly impact policy customization, option A, or claim management, option D. It does help reduce the burden of risk, thereby improving solvency and financial stability. Option C is incorrect because reinsurance typically does not reduce regulatory capital requirements in the same way it reduces risk exposure. Question 30. Which of the following is a key requirement for a Wisconsin-domiciled captive insurance company to remain compliant with the state's regulatory framework? A. The captive must distribute at least 75% of its premiums as dividends to policyholders annually. B. The captive must have a board of directors consisting solely of officers from its parent company. C. The captive must maintain a minimum level of capital and surplus as specified by the Wisconsin Department of Insurance. D. The captive must insure only the risks of its parent company and its subsidiaries. Answer: C. The captive must maintain a minimum level of capital and surplus as specified by the Wisconsin Department of Insurance. Explanation: Wisconsin's regulatory framework requires that captives maintain a minimum level of capital and surplus to ensure financial stability and solvency. The Department of Insurance (OSI) sets these standards to help captives meet their obligations. There is no requirement to distribute a specific percentage of premiums as dividends, option A, and while the board composition, option B, is important, it does not have to consist solely of parent officers. Captives can also insure a broader range of risks beyond their parent and subsidiaries, option D.